Hey guys, Tracy here, Louisiana Mortgage Coach, Key Lending Solutions. I wanted to share with you a client strategy that I worked on today. A customer wanted to look at the options of putting 20% down versus 15% down and wanted to know, how that would affect them over time. So what I prepared for them, and what I do for all of my clients, is a cost estimate. It's going to break down everything, including principal and interest, taxes, insurance, mortgage insurance, if there's flood insurance. I factor all of that in so that you can get a comprehensive look of all of the numbers. So be careful if you're shopping online, because a lot of times they're quoting in the ads principal and interest only. They're not factoring in the mortgage insurance or the taxes and insurance. So if you see this great rate with this great payment, you need to read the fine print. If you have questions, give me a call and I'll help you dissect that ad. But in this situation, this client wanted to put, again, compare the 15 and 20% options. So the first column here, I have a 20% down option on a $300,000 house. They would bring about $66,000 to closing. Their payment would be around $1,398. Based on today's rates, they were around 3.875 for this customer in their credit profile. So great option. Again, no mortgage insurance that they have to deal with, which is PMI. If you're not familiar with that, it's a premium that you have to pay when you finance more than 80% of the value of the home on conventional. You also have that with your rural development products, your USDA loans, your FHA loans. Those will have mortgage insurance either for the life of the loan or a certain period of time. Now this client also wanted to explore a 15% option, which I have in the middle column and in the third column. There's different ways that you can deal with PMI, because in these two situations, you'd be financing 85% of the property's value and putting that 15% down. So PMI is going to be a factor. One of the ways that you can do that is just pay it monthly, and then eventually, once it gets below the 80% mark, at some point it's going to fall off, and then your payment would go down. Doing it this way, putting 15% down, they have about $13,000 in their pocket, almost $14,000 to use for utility deposits, moving, because we all know the curtains that we have in our house and the rugs may not fit the decor or the measurements of the new house. And then you've got all of those deposits and things that you have to, you got to buy a lawnmower if you're coming from a townhome or condo or apartment situation. So those are things that you want to have, and you have a little more flexibility if you have the cash on hand rather than having to finance those things. So in column 2, the payment would be about $1,496 with the mortgage insurance. Again, it would fall off, and you'd bring about $51 to closing. Again, that's about 13-ish thousand savings from the 20% down, and then you could use that for moving expenses, or eventually, if you didn't use all of it, you could actually apply that to the principal and have them recalculate your payment. It's called a recast. We have some options for that as well. The third column is, if you know what, you didn't want to deal with the mortgage insurance on a monthly basis, that's okay. You can pay for it up front. You can, in certain situations, finance it into your loan. But what I'm showing you here is you just pay for the premium and be done with it. The payment in that case would be about $1,469.10 per month. Again, you would not have mortgage insurance per month on that because you're dealing with it up front, and it'd be about $27 difference a month than going with column 2. Overall, both of those mortgage PMI scenarios on the 50% down, you have more money in your pocket. Again, about 13 or 14,000, depending on which column you're looking at. And then you could use that for moving expenses or paying down additional debt that you had, high interest debt. These are 30-year products. I'm going to scroll down to 10 years from now, kind of looking out. Most people typically move between every 7 to 10 years. So if you decided to do one or the other, you'll have paid in about $54,900 or $953 to your principal, about $2,000 more than if you went with the 20% down option. So you have a little bit more into it because more of your money is going toward the monthly principal, and you'll pay that loan off much, much earlier. If you want to look at a strategy for your family, I would love to work with you. I'm at 225-414-4034. Again, there's no right or wrong answer with a 20 or 15% down option. If you want to look at a 15-year, some of those numbers are really, really different. So I'd love to work with you. So please give me a call.